Chat with Traders, episode 48.
The biggest secret of the best traders in the world is that they're just like everyone else. However, they've worked hard to learn the markets and discover what works and what doesn't. But how can you hear about these journeys and get in on the strategies and tactics they use? You can do it by listening to Chat with Traders. Here's your host, Aaron Fifield.
Hey, what's up everyone? Thanks for tuning in to the Chat with Traders podcast. I'm thrilled to have you listening. And this week on the show, I interviewed Linda Raschke. Linda has been an active trader since 1981 when she started out on the floor of the Pacific Coast Stock Exchange as an options market maker. In 1992, Jack Schwager interviewed Linda for his second installment of the Market Wizards series, The New Market Wizards. And since then, Linda has traded for several hedge funds, and in 2002, she began one of her own, which has been ranked 17th out of 4,500 hedge funds for best 5-year performance by Barclays Hedge. During this interview, we covered some great topics, for example, adapting to environment changes, using models to study price behavior, and the part I really enjoyed was Linda's advice to young traders towards the end. So please make sure you pay close attention to this part. I feel like I should probably forewarn you just a little bit. The sound quality is not ideal, but I hope you can push past this because I'm sure you'll learn something by listening to a woman who has been trading for over 35 years. Alright guys, I'm your host Aaron Fifield. This is the Chat with Traders podcast, and here is my guest for episode 48, Linda Raschke. Hey Linda, welcome to the podcast. How are you?
Hi Aaron, fine, thank you.
Awesome, good to hear. And let me say, first of all, it's such a huge honor to be speaking with you. Thank you very much for taking the time to do this.
You're welcome.
I mean, I for sure appreciate it, and I've no doubt listeners will gain a lot from hearing about your experiences, your insights, your views on trading, and any other topic we may get onto during our discussion here. But let's start this off with getting some context and to help us understand where you've come from. So can you share with us how you first got started trading and what were some of your early experiences with markets?
I started on the trading floor back in 1981-82 in the equity options. It was a bit random about how I got down onto the floor. I worked across the street from the exchange and befriended another trader. So, I pushed him to back me, and that's how I got into the business. That vehicle for entree no longer really exists, but in truth, the barriers to entry are so minimal compared to what they were in the beginning. So I hope that would offer a note of encouragement to any new aspiring trader, the fact that the barriers to entry are just so minuscule compared to what they were many years ago. When you're in this business, the longer you're in it, the more you see all the progressions and changes in the industry. So it's not merely a journey of adapting from on the trading floor to in front of the screen, but also one of ever-changing products and methods of execution and even subtleties in the market behavior in terms of efficiency versus noise. And, I always used to laugh that once you find the key, they change the lock. But that truly is true. Every 5 or 10 years, it's a case of Darwinism. You must learn to adapt and go with the flow in that respect. So, yeah, in terms of, the lessons that you learn on the trading floor per se, I guess you have a little bit better perspective in that you're in a universe of a couple hundred people, and you can very quickly see who has longevity and who is gone 6 months later. And, with that, you've got examples all around you of what not to do and what to do. But still, it's an environment where every man's got to find their own particular niche and style. And what one person's doing in the pit next to you is probably not going to be best suited for you. So I'm not so sure that the floor is relevant anymore, but many of the things that I learned down there really aren't pertinent to my trading technique today. It's more a matter of work ethic and principle in terms of taking one day at a time and not trying to project a forecast too far out, and just doing your best to manage your risk for that day's session.
So what are some of the things that you learned specifically from being on the trading floor early in your career? I mean, I know you suffered an $80,000 loss just a few months into your career, which was more capital than you even had at the time. What did you take away from this?
You know, obviously it's a business with a lot of risk, and you know, there's nothing that you can take away from it other than the fact that you respect the market a great deal.
Okay, and I read somewhere that it took roughly 5 years for you to make that money back by trading. Feel free to correct me if that's not right, but I'm interested to know, how far into your career was it before you felt like you were beginning to make some real headway with your trading?
When I first started on the floor, it was much easier to engage in arbitrage in the equity options, where you had a much bigger edge than there was a decade later. There is no edge to equity options now. So I guess that as that edge disappeared, at the same time I also gained in experience. That means just general tape reading and learning to follow the market day after day and seeing numerous different environments. And I think that's one thing that people underestimate, is that you may feel that you're knowledgeable about technicals or a particular style, but it's not until you live that in low volatility, high volatility, bull markets and bear markets, and that's truly where the learning curve takes place. So you really cannot do a whole lot to speed that up. And I do remember probably about 7 years after I had begun my trading career, and we entered into a different type of environment, actually about 6 years, and it was one of just a creeper uptrending market with very little volatility and very few pullbacks, just a steady grinding move higher. And so even after trading for full time for that many years, I realized that I had no idea what was going on or how to categorize that type of price action. So I think you're never fully a master. I still learn every day. There's new things or subtle changes. Maybe after 10 years, I felt like I had solidified a better program that worked for me. But there's always new things that you're recognizing and developing along the way.
Yeah, I really like how you highlighted that you're forever learning and there's always new things that are coming into play. During your time on the floor, how much did you learn directly from other traders compared to what you learned on your own, just from being deeply involved in the market as an active trader?
I didn't really learn anything from other traders, quite honestly. I mean, I can just remember one afternoon where a trader that I was friends with sat me down and showed the way that he calculated conversions and reversals in the derivatives in terms of theoretical pricing. And other than that, everybody had their own style and was doing their own thing. I didn't really learn anything from one particular trader.
Okay, and would you say that was almost by choice because you strongly believe that everyone must find their own way, or was it more a fact that no one really wanted to share information with you?
It's not that people don't want to share or have any great secrets. It's just that, everybody's very much doing their own thing and concentrating on their own business. They all have families to feed and so forth, and different styles, what one person does, it might be selling a premium, and that's not going to suit my risk model or profile. I don't feel as comfortable doing that, so maybe I do something else. I honestly think it's that way upstairs now electronically. You can't go and copy another trader. A trader's only somebody that can really come up with their own thing, and then you have confidence with it, and you've done your own research, and you know when it's working, and you know when it's not working. So I really about the only thing I learned on the floor was the person who backed me initially was the one that taught me how to keep track of market internals, meaning a 10-day moving average of the advanced decline and the trend, and there were some things that are outdated nowadays, QCHA, specialist shorts, put-call ratios, those types of things. But even so, it's up to the individual's interpretation of them as well as putting them in the right context. Nobody else can do that for you. And it's not like a black and white, right or wrong. It's all a little bit of an art, and a little bit of a subjective framework and feel.
Yeah, great answer, Linda. Now, you were a floor trader for about 6 years. When was it that you decided to move on, and what was the next step for you?
Well, not to prolong this, but I've said this several times in many different interviews and so forth. I had a bad accident where I had broken some ribs and dislocated my shoulder, and I really couldn't stand on the floor for a period there. So at that point, I started trading from upstairs.
Right, and I believe it wasn't long after that, maybe a couple of years, that you were motivated to change to futures markets after you'd already been trading equities and options for quite some time. I'm curious to know what inspired the shift.
Well, it wasn't necessarily by choice. After the crash of 87 and then after 89, the liquidity just dried up in the options. So there really wasn't much to trade. And this is a recurring theme that you'll hear expressed with many traders that have been in the business for 3 decades or so, is that you have to be flexible to move to different products or where the volatility and the volume is, and it might be in one particular product or market for a period of a couple of years, and then it changes. You've seen that many times. Some of the products that they came out with in the late 80s no longer exist. For a period there, I remember I was in the pits in the value line options. They actually had equity options on the value line index. Well, that disappeared many years ago, and the OEX don't trade anymore. Some of the products that they came out with index futures originally on the Amex, they called it the Fancy or the XMI, that no longer exists. If you've heard about the SOS Bandit, that particular modus operandi no longer exists. So, some of the markets that I used to trade no longer exist. Pork bellies don't trade anymore. So it's just, you always have to be ready to go where the action is, if you will.
Yeah, and did you find any challenges in being forced to jump to a different market? Was there any challenges or hurdles you had to overcome to adapt to these new markets that you were now trading?
No, it's Darwinism. You make the jump or you die. Some people can adapt and change, and others never do. So it's I think you just it's like being an entrepreneur. You always have to keep an open mind and look for opportunities, no matter how they present themselves.
Sure, okay. Now, Linda, let's say I know nothing about how you trade. How would you describe your style of trading and approach to markets? So share with us like the timeframes you trade and some of the opportunities that you're actively seeking out.
Well, not to be cliche, but the market's either going up or it's going down, and it either stops going up, in which case it's probably ready to reverse, or else it stops going down and finds support, So I'm pretty much real basic with regards to that, looking, it's just like the tide's going in and the tide's going out, and you want to, be positioned to be riding the tide in either direction. And of course, it's not always so clear cut, so sometimes you're sticking the toe in the water and, maybe it's just a little tide or a little current, but what you're really doing is waiting for, that big wave or those big money flows or that big volume day, which might only come 2 or 3 times a month. So that's, it's a lot of the trading aspect is staying in the game until you see your opening and not forcing anything. So very much like playing a tennis game, you're just keeping the ball in play until you see that one moment where your opponent is caught off guard, and then perhaps you can go in and put away the ball or put away a winner, but you can't force it to happen. You have to stay in the game until you see your opening. And, I'm sure there's many other analogies one could make, if you're a poker player, what do? You stay conservative and stay in the game until you feel like the deck is hot or you've got a really hot hand, and then you can press it bigger. So I think all those analogies apply to trading. So in terms of style and time frame, that's just simply going to be a matter of how much risk you want to assume. Obviously, I think that the big money is made holding overnight, if not for one day, maybe for a couple days. But now you also have more risk, theoretically, in a overnight risk or event risk or a longer holding time. I don't see any big money being made with day traders, but you certainly can have some fabulous days day trading.
Okay, so you would say that you trade a mix of time frames, so you also are active intraday as well as those trades that you might hold for, 2-3 days and so on?
It really depends on the volatility level of the particular market, because as the volatility level is higher, you can certainly trade much more aggressively on a short-term basis. You have bigger swings intraday, bigger moves, and better liquidity. And what happens is that as the volatility contracts and range contracts, you have much less frequent opportunities, but you really need to go out to a longer holding time. So part of it is determined by the overall volatility of the market.
Okay, interesting. Now let's take that one step further. Are you able to share some of your favorite chart patterns or setups that you like to trade?
I think this notion of chart patterns and setups is, it puts things in a very linear framework, and of course the markets don't really move in a linear fashion. So if everything's going to be in a trending channeling mode or a consolidation mode where it's a noisy range, and the ranges these days are much noisier than ever before, or you're doing a climax sale and then a retest and perhaps trying to see if you can shift some supply demand in the opposite direction. And I like, Wyckoff probably still has the most appropriate market model out there in terms of test or retest and contraction and so forth and so forth. So it's easy to look at a textbook and see these contrite examples of chart formations, but you know as well as I do that in real life, you are going to find those types of chart examples far and few between. So I think it's much more important to recognize, is there strong volume on the day and a strong chance of a directional bias for the day, or even if you're on a longer time horizon, that swing for the week, or are you much more prone to a rotational type of mode, in which case, you are probably going to have a shorter holding period of time, and you have to be a little bit more careful about your initial trade location.
Okay, this is really interesting. So, I mean, how do you identify good trade locations? I guess that might be a better question. Like, what gives you conviction to, put on a position and take a trade?
Well, if the market's consolidating, we're forming a trading range. Let's just look at the yin and the yang. Let's say, for example, that you've just had a large standard deviation move, for example, 6 or 7 standard deviation move over a multi-week period. And then the market's probably going to consolidate and go through a testing process. Could be for 1 week, could be for 6 weeks, and when it's going through that testing process in terms of trying to find an equilibrium level or a balance, in the supply-demand, you really are not going to have favorable opportunities unless it's testing the upper or lower end of the boundaries, okay? So, you see a chart formation and your best opportunities are going to come on tests of the highs or the lows, the little mini whipsaws, if you will call it that. It's lethal to try making trades in the middle of the range. It's just a noise fest. When a market is actually breaking out and trending and making its move to a new level, trade location really is irrelevant. It's much more a matter of get the trade on, and participate in that move. So you have two different styles there, if you will. And nowadays, everybody's smart. Everybody's very knowledgeable. Everybody has, extremely fast bandwidth and so forth, and can digest information instantly, unlike 20 years ago. So once a market tips its hand, the moves are very efficient, meaning if you want to wait for a pullback to have a graceful entry, you're probably going to be left in the dust and having to enter at after the market's already moved quite a bit. So context really is important in trading.
All right, cool. Yeah, thanks a lot for sharing that, Linda. That was really insightful. And I noticed on your charts you use a number of indicators and oscillators in particular. A lot of traders have very mixed opinions on these types of tools. I'm keen to hear, what are your thoughts on using indicators, and to what extent do they influence your trading decisions?
Well, when I actually model the market's price behavior or do any type of quantitative work, I really use price functions such as average true range, things along those lines. It's not going to model out well if you try using a derivative of price, meaning like an oscillator. I just stick to one oscillator. It's a moving average of a 3 and 10 period simple moving average. And it's just there to support the charts. I mean, you can train your eye and see the same thing without the oscillator. It just makes a little pretty feel if you start to get a loss of momentum in a trading range. So it's just a little bit of a crutch It smooths out the data a tad, but you're not necessarily going to make a decision on that per se. It's just supporting evidence that, price is always going to lead. The price is always going to be 1 or 2 bars ahead of a turn up or down in an oscillator. It just helps make a pretty picture.
Okay, so you have a focus on becoming intimately familiar with the markets that you trade. So just for an example, let's say you have 20 futures markets that you know intimately. If you were introduced to a brand new market tomorrow, what are some of the first steps you'd take to becoming intimately familiar with this market also?
Well, the first thing that you always want to evaluate with any market that you are not as familiar with is the liquidity, because it's never a problem getting into a market. It's always a problem getting out if you need to get out very quickly. So it's just like if you test drive a new car, the first thing you want to do is not test the gas pedal, you want to test the brakes, So it's the same thing with the market. You want to make sure that you can get out of it, That's what I always look at.
Okay, liquidity. So that's definitely a big one there. Linda, you've been trading for over 35 years now. Let me ask you, to what degree is intuition and instinct a contributing factor to your trading success?
Instinct, I would say 0. All these things like intuition, really what you're talking about is just getting proficient at monitoring the tape. And what do they say? Intuition is just a sum of experience. So, I can think of just as many times where I had a hunch and it was wrong as it was right, which is why I really try to trade around a model. Even then, at least I know when the model's wrong. So I think that you have to have a core methodology or something that's going to add consistency to your approach to the market. You need to have a very consistent approach or framework with which you deal with the market. So when you start popping in words like intuition or hunch or these types of things, immediately you are starting to question your consistent framework. Now, with that said, I can have my consistent program and model, and I know when something's not going. If I initiate on a buy signal and the market's feeling really sticky and not really moving as much as it could otherwise, I wouldn't necessarily call that intuition. I would just say it's more noting the reaction of the price to the framework, that I had. And if it said, hey, everything's ready, for a green light, go to the upside, but, they're not taking the ball and running with it, and, it's just a dead market, or, it's perhaps there's, the market's already way too long and it's just not going to go anywhere.
Sure. All right. So you've mentioned models a few times. I'd really like to dig into this and learn a little bit more about what you're referring to here. So can you help us to understand how you use models to study price behavior, and how do you then take that information and apply it to your actual live trading?
Well, anytime you start to think about developing a model, it comes from asking a question of the market. So, for example, a simplistic example would be if the market has gone from low to high 2 days in a row, what happens the following day? What percent of the time does it go from low to high the next day, or from high to low the next day? So that's a basic departure point. If we've been up 2 days in a row, what are the odds that it's going to be up a third day? And then if we say, and if it is up a third day, then what does that imply? So you can start building on this, and you can start saying, gosh, if the market's up 7 days in a row, now, that might indicate that you've got some reason for persistency of trend, and perhaps it could go up 14 days in a row. So this is your basic modeling. It's usually from just asking one question and then trying to quantify that with just one or two variables. So you end up with something that's very durable and robust, but it's not going to give you anything that you would use to bet the farm on. It just provides a framework. So let's take that example of low to high, low to high. Now I've had 2 up days, and I'm in a normal trading environment. Perhaps I'm below the 20-day high and I'm above the 20-day low, meaning that I'm in a range. So once I can add a little filter like that, I'm not making new 20-day highs or new 40-day highs, but I'm in a range, and I had 2 days low to high. Perhaps my model would tell me then that the next day I should look to trade from the short side. And so it gives you a bias, if you will. And then I would know pretty quickly if my bias was correct or not, because I'll come in and it's sort of like the old saying with the art of war, you prod with bayonets, and if you encounter mush, you advance, But if you encounter steel, you back off. In other words, if you're not getting anywhere, you back off.
So how do you then take that information and apply it to actually live trading scenario? Are you trading specifically what you've discovered from, doing your modeling, or is it just a guide?
My modeling gives me my game plan the night before, so I can come in with n number of markets and say, we've got great sell divergences in this market. It's falling into my little framework here. If it starts to break to the downside and there's an increase in volume, I'm going to add to my position or be all over it. And so, what my models do is they give me my preparation the day before, and then, when I come in and I sit down in the morning, it's like, the dealer is dealing the cards. Let's go, So it could be very analogous to if you look at football or baseball or a sport, you're going to, the night before, you're going to be studying the behavior of your opponents. You're going to be seeing, okay, does this team have a tendency to pass or to run? Who are the strong players? Who are the weak ones? Where am I most likely to get an opening, right? But then boom, when they blow the whistle and the game starts, the conditions could change. It could be rainy, in a sloppy field, or your best man could be out and you have to make adjustments. But at least you've done your homework so that you are prepared, if you do get an opportunity to capitalize on something.
Okay. Yeah, so it's kind of like if your bias is confirmed by the market, your modeling gives you extra conviction on that trade. Is that a...
Absolutely. And what you learn is that it doesn't matter if it's a mechanical system or a discretionary approach. Probably 80% of your profits are going to come from 10% of your trades. Even if you're a day trader, you'll find that 80% of your profits will come from 10% of the days. It just is the way that it plays out. So you're always trying to stay prepared and ready, with the hopes that you get that opening and can jump on it.
Okay, excellent. Now, are you using mechanical trading systems alongside your discretionary trades?
I don't right now. I have in the past. They're more for good discipline. They're more for, for example, there's been periods in the past where, I feel like I'm starting to spin my wheels, or I don't really have any clear-cut play, and, or perhaps I've experienced a drawdown or a particularly disorienting loss, and a good way to get back into the game is a volatility breakout system. So I've used that on and off, every 5 or 6 years to sort of get the ball going again and have a mechanical guideline to, keep pulling the trigger and keep managing the trades. And with that said, I've never really made much money with a volatility breakout system. It's not something I would recommend for somebody to make a living, but, you're not going to get hurt either. If you traded a volatility breakout system for 6 months, I would say there's still 90% odds that you'd have a positive equity. It's just a lot of work, it's a lot of work and it's not real fun.
Yeah. Now, Linda, how do you prepare for each session or day before the bell rings? Could you shine some light on your daily routine? Obviously, presuming you've got one, of course.
Yeah, I find that it works best for me if I do my game plan the day before after the markets close. I don't like to come in the morning and have to scramble to put something together. So I really do best if I can go to bed feeling like I'm already prepared for the next day. And it's sort of like taking a test, and using a number 2 lead pencil. Your first guess is probably your best guess, So I just try to make my best guess the night before, as to what's going to play out or, where the openings might be. And of course, we have to adjust everything to how the market's traded overnight. That's just part of the game.
Excellent answer. Yeah, that's a really great point. Now, you said at the end of your Market Wizards interview, I know this was quite some years ago, but you said, "I really believe that I can become one of the best traders around," and I really like that line, and it shows that you're very confident. And I feel many traders probably lack such confidence. So I'd like to ask you, are you successful because you're confident, or are you confident because you're successful?
No, you're never confident because you're successful. It doesn't work in that order. I think that it's more that you're confident in your ability to focus, and I would say above all, concentration. And that's what I see will affect me, and I'm sure it's that way with 90% of the people around, that your success is going to depend on your ability to concentrate, particularly in the past number of years, because it's so easy to have pervasive distractions. The social media, the Twitter, the TV, the tweet decks, the blah, blah, blah. I don't even know all this stuff. All the blogs, the emails. I have no idea how somebody can concentrate and trade well with all these extra opinions and energies and noise going on around you. I think that you need to figure out for yourself how to totally eliminate the noise and then concentrate on your own strategy. And for a lot of people, myself included, I feel that if somebody else if I hear somebody else's opinion or strategy, I feel like I'm in a lose-lose situation. Damned if I do, damned if I don't. I don't want to know what anybody else is thinking. I don't want to know what somebody else's work is. I want to know what my work is, and then how the market is acting according to my plan, and then I can do best. So I think the confidence comes when you're in that mode of, not to sound cliche, but trading is a performance-oriented sport, if you will. And so all those books that came out 15 years ago talking about flow, and staying in the moment, and now it's sort of gravitated towards this mindfulness terminology, but it's all the same thing. It's all your ability to concentrate and focus, and I think that is what ultimately gives somebody confidence then.
All right, brilliant answer. And Just while we're speaking of cliches, I know this question is kind of along those lines, but I've got to do it. Is there any advice you'd like to pass on to younger traders that would be beneficial to them? And of course, feel free to repeat anything that we've already discussed too, if that's what you'd like to really emphasize.
Yeah, I don't like sounding cynical because I'm not a cynical person per se, but I would suggest that you take anybody else's opinions that you see expressed on internets and blogs and tweets and so forth, take them with a grain of salt, okay? Perhaps those people are doing well. Perhaps they're only more vocal when they're having good trades, and a lot of, quote, educators out there honestly couldn't trade their way out of a paper bag. That's why they're doing other activities, and I know you can make such a ridiculous amount of money, as a CTA or a fund manager or managing other people's money. It's not even funny. So, if you can trade well, you're certainly not going to be out there trying to teach other people how to trade. It's a bottom line business, and if you can put together a good bottom line consistently, trust me, the money will just flow to you, and you can make so much more. So really, have your antenna up. And I'm not here to diss people in general. There's some good people out there, but it's really important that you find your own style or something that makes sense to you. And the best way to start out is print off charts of key moments, of where there was a big move. Print off charts of these and see what the price action looked like leading up to that, So it's sort of a deductive type of logic, in backtracking back here and seeing if there's some common elements or common themes, and then how can you position yourself in that direction. It's really good old-fashioned detective work, and it's not going to come, in my opinion, from looking at artificial constraints on the market. And by that I mean, Fibonacci numbers or Gann numbers or all these types of things. And by the way, Gann, up until like his very last 2 or 3 years when he had syphilis, was a basic swing trader. If you read all his early work, it's swing highs, swing lows, cycle anniversary dates and stuff. It wasn't all these little goofy, spirals and all that kind of stuff when he was pretty demented in his head. He was just a good old-fashioned swing trader, as was Wyckoff and all those early works. So, do your own work. And then what you want to do is you want to just concentrate on one initial pattern, and meaning one initial play, either a breakout type of thing or a retracement into the direction of the trend. And see if you can make a little library of those. See if you can capture 20 examples of those. Print them off and make a little notebook. And then as you see them unfold real time, maybe you just get 2 a week and start to keep statistics on your own ability to replicate something in that direction. And don't think about trying to capture a big play. Think about only trying to take a couple ticks out in the direction of that movement, okay? And if you do that, then just let it go on to the next trade. And what you'll find is that initially, perhaps your ability to capture a piece of the swing might be capturing just 10% of that swing, you see? But if eventually you can capture 1/3 of that swing, that's a really good metric by which to measure yourself against. So you have to find something where you can make it a game against yourself. You see, can I have 5 winning days in a row? Can I make 3 winning trades in a row? And it's keeping track of your own records and performance statistics, you see? And you have to make it into that type of game for yourself. And then it will help you free yourself from the ego-driven drive to call a market right, to say, oh, I called the turn, oh, it's going up, oh, it's going down. And that's really not what trading is about. It's not that we're smart and we can foresee something in advance. It has nothing to do with the markets. It's more, imagine you're out on the sea and you're surfing. Nobody can see when that seventh wave is going to be the big wave, right? You just try and get up on your board and stand up on the board numerous times, and then, whoa, lo and behold, you catch that big wave, but you can't say, oh, that big wave is going to come in 11 minutes from now. It doesn't work that way. So it's very much with the markets. You're really at their mercy, and let go of all this, egotistical stuff, and then you'll really be the better trader and the better breadwinner for being able to extract profits from the market. It's just being ready to take what the market gives you. And I hope that makes some sense. I really feel strongly about that. I feel incredibly strongly that people think that there's an easy way, or they think that they can follow a guru or somebody else's, perhaps path. And the only people I see really make it in this business have found one little arbitrage that they can relate to for themselves. And then they can expand on that. And once you've reached that point, there's no harm in seeing what other people are doing and extracting ideas. Then you take that idea and you say, well, maybe I'll add my little twist to that. Maybe that only happens on Fridays. Maybe that only happens when the first hour's volume is greater than the previous day's first hour volume. You see? And that's sort of the evolution of constantly coming up with ideas and growing with the markets.
Excellent response there, Linda. That was really brilliant. Thank you very much for sharing that, and you've definitely given us all a lot to think about. So I appreciate you going to lengths to explain that to us. Before you go, do you want to share with listeners where they can go to find out more about you, and where can they connect with you?
Oh my goodness, I have a little website up that I've been pretty negligent in posting to this year. I kind of set up this blog format, and I'm a pretty crummy writer. I should get back to doing something like that, but I think there's a contact form on there if you had a question and you wanted to contact me. Other than that, I'm sure there's a proliferation of information on the internet. I know I've done YouTube videos for Big Mike Forum or Money Show or goodness knows, so much stuff over the past. So I'm sure nobody would have any problem finding much material for free. Hey, for free out there.
Yeah, well, I found a bunch of great resources while I was doing some homework for this interview. So I'll be sure to link to those in the show notes to this episode. So anyone listening, if they want to get the show notes and links to find out more about Linda, go to chatwithtraders.com/48. Everything will be there in the show notes. Now, Linda, thank you very much for doing this. It's such an honor to speak with you, like I mentioned earlier. I really appreciate you taking the time to do this. Have a great evening, and let's speak again soon.
All right. Best to you, Aaron.
You've come to the end of this episode of Chat with Traders, but don't worry, more great episodes are on the way. To stay updated with each great new episode, be sure to subscribe to the podcast in iTunes, and we'd love it if you leave us a rating and review. We'll see you next time on Chat with Traders.